So, good afternoon. So we had started the evaluation of the debenture or the bond. So there's a question we specified. There is a question we specified that we continue with that question. It was September 20 what? September 20. So we go to the question for September 2021, question number 1, part C. September 2021, question number 1, part C. We now go to the question for September 2021, question number 1, part C. So that question reads that, the question that Belt Limited issued a 16% corporate bond. They issued a 16% corporate bond with the above value of shillings 1,000. With the above value of shillings 1,000. So the bond will either be redeemed at 20% premium after 5 years or convertible into equity at a conversion rate of shillings 100 per 2 ordinary shares. Each ordinary share is currently trading at the Securities Exchange for shillings 50. So it is expected that the share price will increase at a constant rate of 5% each year. It will be able to increase at a constant rate of 5% each year. So minimum required rate of return by the investor is supposed to be 12%. So required current value of the redeemable bond. Roman letter 2, current value of the convertible bond. The current value of the convertible bond. So starting with what we had discussed today, So we saw when you want to get the value of the bond, value of the bond was supposed to be equal to value of the bond. Today, you are able to see that value of the bond is supposed to be equal to present value of the interest. Present value of interest per period. Then you are supposed to add present value of the interest. So the present value of the maturity value. Present value of the maturity value. So when you want to compute the value of the bond, it will simply be equal to present value of the interest per period. Then we add present value of the maturity value of the bond. So we start with the Roman letter 1, the current value of the redeemable bond. So we start with the Roman letter 1, the current value of the redeemable bond. So the first thing we shall calculate will be interest. The first item we require to calculate will be interest. So to compute interest, the coupon rate was given as 16%, the corporate bond. So you get 16% of the par value. We get 16% of the par value. And the bar value had to be given as 1,000. So get 16% of 1,000. get the 16% of the 1,000. So that should be able to give us around which one? So it will be able to give us 160. Then we also compute the maturity value. So maturity value, this bond is redeemable. This bond was redeemable. So they have said that the bond will either be redeemed at what percent? 20% premium. So our premium is an increase in the bond. Discount is a decrease in the value of the bond. So because it was redeemed at a premium, the maturity value during the redemption period will be 120%. The premium is 20%. So we get 120% of the bar value. We get 120% of the bar value. And the bar value was how much? 1,000. So that now will be the maturity value. Because we are talking about redeemable bond. So it was redeemed at a 20% premium. So this should give us 1,200. Yeah, so now from there, we compute the present value of the interest. Present value of the interest. So it will simply be the annuity multiplied by present value interest factor for the annuity. So the minimum required rate of return is the cost of capital. It was 12%. So the maturity period is how many years? 5 years. So you take the 160, then confirm in the annuity table. Confirm in the annuity table what is 12% in year 5. In the annuity table is the second table. 3 point. 3.6 48 letters. Yeah, so we get the present value of the interest on the basis of that. Then we also calculate present value of the maturity value. So present value of the maturity value. The present value of the maturity value, it should now be the 1,200. But this one, we discount it using the first table, which is supposed to be 12% in year 5. So it is 1,400. So confirm 12% in year 5. 0.5674. So now add those two figures together. It should be able to give you the redeemable value of the bond. That now should be able to give you the redeemable value of the bond. So that should be the Roman letter 1. So let us now go to the Roman letter 2. Roman letter 2, they wanted you to calculate the value of convertible bond. So Roman letter 2, we now compute the value of the convertible bond. The value of the convertible bond. The value of the convertible bond. Now calculate the value of the convertible bond. So to get the value of the convertible bond, the procedure is still the same. The procedure is still the same, whereby value of the bond will simply be equal to present value of the interest per period. Then we add the present value of the maturity value. So interest is not affected. Interest is not affected. Okay. So what is changing is now the maturity value. What will be changing is now the maturity value. So you want to see how to compute. Now the maturity value. What is changing is the maturity value. So that maturity value, I want us to calculate it down here to see how to calculate the maturity value. I want to see how to calculate the maturity value. So to get the maturity value, they say that the bond can be converted into how many ordinary shares? So convertible bond into equity at a conversion rate of 100 per 2 ordinary. So each bond share is currently trading at the securities exchange at how much? At 50. So we want to know how many ordinary shares are they at the moment. So it can be converted into ordinary share, and each ordinary share is currently trading at how much? At 50. So to get the number of the ordinary shares, because the bar value of the bond was 1,000. The bar value of the bond was 1,000. Then each share is going at how much? At 50. So how many ordinary shares are we going to have at that particular portion? There are 20 ordinary shares. Then they have also said that each share is currently trading at securities exchange at 50. But it is expected that the share price will increase at a constant rate of what percent? So for 5 years, isn't it? Because it was meant to be converted after 5 years. So market price per share in year 5. You take market price per share in year 0, then 1 plus G raised to the power of 5. Raised to the power of 5. So to get the market price per share in year 5, you take the market price per share today in year 0, then 1 plus G. So that market price per share today is 50 shares. Then 1 plus G. It is growing at what percent? At 5%. So 5% the same as 0.05. Then rest the part of 5 years. Because you want to get it when it grows at 5% for 5 years. What should be that value? What should be that particular value? 3.81. 63.81. So we get 63.8. So now after that, we get the maturity value of the bond. So the maturity value, it was converted into 20 ordinary shares. But after 5 years, each share is going at 63.81. So multiplied by 63.81. So that we get that the maturity value of the bond when it has been converted into the 50 ordinary, into 20 ordinary shares. So this one should now give us which figure? 12. So everything remains. You come here because interest not changed. So this is what has changed. This is what has changed. Change it 12.76.2. Also, you come at this point, you get 12.76.2. And now multiply by. So the rest of the information is not changing. The only item that has changed is the maturity value. The rest of the detail are the same. So get now the value of the bond from that. So that now should be able to give you what is supposed to be the value of the redeemable bond. So the convertible bond. That now should be able to give the value of the convertible bond. So that is now your Roman letter 2. That should be our Roman letter 2. So it is it more or less than the one for the Roman letter 1? It is less. Should be more. Should be more because this one, remember we used 1200, but now it is 12.76.2. So it has gone up by that small fraction. So that should be for that particular question. So there's another one more last question. This one should be May 2018. May 2018, question number 1, part B. So our last question should be May 2018, question number 1, part B. Yes. This one, this one, you just repeat it. That one has not changed. Yeah. In one that week, and 60 multiplied by this. Give you 7, 5, 576.7. 9 multiplied by 9, 680. 7. It is 724. Yeah. So you see why the problem is. So the value for the bond, I said, interest has not changed. It will remain 160. But now the maturity value I calculated here, got this. Then now you get the value for the bond. You present it exactly the way it is. What I changed was only the maturity value. Then you get the new value for the bond. So online, I hope it is clear. Someone had given me 13,009. 3. You know which value? Okay. So let us now go to that question for May 2018. Question number 1, part B. May 2018. Question number 1, part B. May 2018. Question number 1, part B. So May 2018, question 1, part B. May 2018, question number 1, part B. The question reads that Longo Limited wishes to expand its business. Wishes to expand its business. The company is considering to issue 50 million worth of redeemable bonds denominated in shillings 1,000. The bond rate of interest is 10%. The bond rate of interest is 10%. And it will mature on 30th June 2028. It will mature. I said May 2018, question 1. Is it question 1, part B? Yeah, so it will mature on 30th June 2028. So the bond will be issued on 1st of July 2018. So cost of capital is 18% per annum for the whole period. So required the current value of the bond. Current value of the bond is the same as the market value of the bond. Today we discussed what is the market value for the bond. Current value of the bond is the same as the market value of the bond. Roman letter 2, the bar value of the bond. The bar value of the bond today we discussed the same as the floor value of the bond. Is the same as floor value of the bond. So there is a question we did in the morning where they were asking you to calculate the market value for the bond, the floor value of the bond, and the conversion premium. So those terms, we discussed them today. So current value of the bond will be the same as the market value of the bond. The bar value of the bond will be the same as the floor value of the bond. So we discussed something about the floor value. The floor value of the bond. All those terms, we discussed them in that particular question. So we start off with the Roman letter 1. How to calculate the current value or the market value of the bond. Current value or simply the market value of the bond. The current value of the bond or simply market value of the bond. Or simply the market value of the bond. So to compute the value of the bond. Value of the bond. Value of the bond is the same as present value of interest per period. Then we also add present value of the maturity value of the bond. Present value of maturity value of the bond. So we are calculating the market value for the bond. Roman letter 1 or the current value for the bond. So we start by computing interest. We start off by computing interest. So to calculate the interest, for us to come up with the interest. Interest is supposed to be equal to, you can see the interest rate. The bond rate of interest is 10%. So we get 10% of the bar value. 10% of the bar value, which is 1,000. What should be 10% of 1,000? 100. Then we also need to calculate maturity value of the bond. Maturity value of the bond. So this time round, when you want to get the maturity value of the bond, you take the bar value today. It is earning interest of 10%. So it was to mature. Remember, it was issued when? It was issued on 1st of July 2018. But it's supposed to mature on 30th June 2028. That's a difference of how many years? It is a difference of 10 years, isn't it? So you take the 1,000 today. So 1 plus the interest. Interest is meant to be 10%. Interest is meant to be 10%. So 1 plus 0.1 raised to the power of 10 millions. So it will then multiply by 1,000. So that now will give you the maturity value. That now will give us, because now we have factored in the interest for each year. So it should be able to give us 25. So 25, 93.75. So that now will give you the maturity value of the bond. So now we compute the present value of the interest. So now compute the present value of the interest. So it is simply annuity multiplied by the present value interest factor for the annuity. The cost of capital has been given. You can see that cost of capital 18%. So it is 18% for how many years? 10 years. So it is interest is 100. So 18% in year 10 for the annuity table. Your item, 18% is not there in the table. Then I had shown you how to calculate that. For the second table, that's the annuity table. It is normally 1 minus 1 plus r. That's the power of -10 divided by r. So for the second table, to calculate the value in that table, we normally use this formula. So when it is not in the table and you are looking for the value for the second table, you apply this. So it will just be 1 minus 1 plus 0.18. That's the power of -10. Also divided by 0.18. So that figure that you will get, I would like you to round it off into 4 decimal places, because the values in the table are rounded off into 4 decimal places. They are rounded off into 4 decimal places.
I think those are
0.49. Four nine four one like that. 4.494. So that is now for that. Then once we have done that, we now also compute the present value of the maturity value. The present value of maturity value. So this one you simply take what is there as the maturity value, which you got 2593.74. So we discount it at the present value interest factor. So this one we use the first table, 18%. So you simply take 2593.74. So also that figure is not in the table. When you are calculating for the first table, I showed you it is 1 plus r raised to the power of -n. When you are calculating the value, it is 1 plus r raised to the power of -n. So you also take 1 plus 0.18 raised to the power of -10. So it will give you which 0.1912. So now you can get the value of the bond. So that now should be able to give you the value of the bond. So it should be able now to give you the value of the bond. So that is now our Roman letter 1. That should be our Roman letter 1. So we go to the Roman letter 2. We now go to the Roman letter 2. Roman letter 2 is the bar value of the bond. Bar value of the bond or floor value of the bond. Bar value of the bond or simply the floor value of the bond. The bar value of the bond or simply floor value of the bond. So maybe for those who are not in the morning, you can just comment by writing that it is the value of the bond. It is the value of the bond where the maturity value is the same as the bar value, where the maturity value is the same as the bar value, where the maturity value is the same as the bar value. So all these details will remain. What has changed is this maturity value. So now our maturity value will simply be the bar value of the bond, which is 1,000. Then the only other item we are going to change. You repeat everything, but now you change this one to the bar value of the bond. So this one becomes 1,000. Also this becomes 1,000. So the rest have not changed. So now get that value of the bond. Get that value of the bond. So now you are getting which figure? Yeah, so that is now all about valuation of securities. That is now all about valuation of the securities. So now we start a new topic, which is supposed to be cost of capital. So now we start a new topic as the cost of capital. We now go to a new topic as the cost of capital. So under that, we can write that, we can summarize that. This is the required rate of return. This is the required rate of return by investors. This is the required rate of return by investors who have provided funds to the company. This is the required rate of return by investors who have provided funds to the company. Who have provided funds to the company. Who have provided funds to the company. They include Roman letter 1, cost of equity. They include Roman letter 1, cost of equity. Roman letter 2, cost of the preference shares. Roman letter 2, the cost of the preference shares. Roman letter 3, cost of the debenture. Roman letter 3 will be cost of the debenture. The cost of the debenture. So we start off with number 1 as cost of equity. Start off with number 1 as the cost of equity. Cost of equity. So When it comes to the cost of equity, we shall summarize that equity refers to shareholders' funds. Equity refers to the shareholders' funds. Equity refers to the shareholders' funds, and it is classified into two categories as follows. And it is classified into two categories as follows. It is classified into two categories as follows. A will be ordinary share capital. A will be ordinary share capital. Then B will be retained earnings. So A is the ordinary share capital. B is the retained earnings. So we start off with ordinary share capital. We start off with the ordinary share capital. So under the ordinary share capital, we note that the cost of the ordinary shares is classified. The cost of the ordinary shares is classified into two categories. Depending on how the dividends are paid as follows. The cost of the ordinary share is classified into two depending on how the dividends are paid as follows. Depending on how the dividends are paid as follows. Depending on how dividends are paid as follows. So Roman letter 1 will be 0 dividend growth rate ordinary shares. Roman letter 1 is the 0 dividend growth rate ordinary shares. So you had already seen today how to get the value of the 0 dividend. So now I will simply be giving you the formulas, how to get the cost of that. So we have started with the Roman letter 1 as 0 dividend growth rate ordinary shares. The 0 dividend growth rate ordinary shares. 0 dividend growth rate shares. Shares. 0 dividend growth rate ordinary shares. So I will simply give you the formula. So KE will be the cost of the ordinary share. KE will be the cost of the ordinary share. So it will be equal to D divided by P4, but now we minus the flotation cost. We shall be able to express it as a percentage. We shall now be able to express it as a percentage. So D is the dividend per share. D is the dividend per share. D is the dividend per share. PO is the market price of the share. PO is the market price of the share. Then F will simply be the flotation cost. F will be the flotation costs. F will be the flotation cost. That's now how to get the cost of the 0 dividend growth rate ordinary share. Then number 2, or Roman letter 2, will be constant dividend. Constant dividend growth rate ordinary shares. Growth rate ordinary shares. Also have the constant dividend growth rate ordinary shares. The constant dividend growth rate ordinary shares. So we already know the formula for this. We are simply making KE to be the subject. It will be given by DO in the brackets of 1 plus G divided by PO minus the flotation cost. Then you So finally, it is the same as T1 divided by PO minus the flotation cost. Then we add G like that. So that will be now how to compute the cost of the ordinary share with a constant dividend growth rate. We know this except the flotation cost, but they were there when you are calculating the value of the ordinary share. Remember the value for the ordinary share with a constant, it was PO. PO was given by DO 1 plus G divided by KE minus G. So remember that formula? So we are making KE to be the subject. When you make that KE to be the subject, it will be like this. The only item I've now added is what? The flotation cost. But that formula comes from this. You make KE to be the subject. When you are raising new funds, we normally incur some cost we refer to as the flotation cost. So this one is coming from this. You are simply making KE to be the subject. So that is now the cost of the ordinary share. We have said that equity is classified into two. Let us now go to being the retained earnings. We now go to the cost of the retained earnings. Now we said equity was classified into two, ordinary share capital and the retained earnings. So now we go to the retained earnings. Now we go to the retained earnings. When it comes now to the retained earnings, we first note that these are internal source of finance. These are the internal source of finance. They are the internal source of finance. Internal source of finance, which will not incur the flotation cost. Which will not incur the flotation cost. Which will not incur the flotation cost. Therefore, the cost of the retained earnings. Therefore, the cost of the retained earnings. Therefore, the cost of the retained earnings is the same as the cost of the ordinary share. Therefore, the cost of the retained earnings is the same as the cost of the ordinary share. It's the same as the cost of the ordinary share, except that there will be no flotation costs. So the cost of the retained earnings is the same as the cost of the ordinary share, except that there will be no flotation costs. Except that there will be no flotation costs. Except that there will be no flotation costs. Then we continue by noting that it is calculated as follows. It is calculated as follows. It is calculated as follows. So we just repeat what we have done as follows. Just repeat what we have done in this one. So you start with the first one. So this first one, we say that in case of zero dividend growth rate. So everything will remain, but this one you make it KR, then you also remove the flotation cost. Then Roman letter 2 will be in case of constant dividend growth rate ordinary share. You only change this one to KR. Then there is no flotation cost. So that's now the summary on how to calculate the cost of the retained earnings. It is the same as the one for the ordinary share, but now there is no flotation cost. But now KR is referring to the cost for the retained earnings. KR will be referring to the cost for the retained earnings. So all the details remains. We only remove the flotation cost. We remove the flotation cost. So that is now about equity. So we got the second category, which is the cost of the preference share. We now got the cost of the preference share. When we started, we classified them into three. The cost of the cost of equity, cost of the preference share, and the cost. So now we got the cost of the preference share. We now go to the cost of the preference share. So I will also only be giving you the formulas because there is no need of us going into detail for that. So we now also come up with the cost of the ordinary share. So come up, so the preference share. So to get the cost of the preference share, it will be the same as KB. KB is the cost of the preference share. So it is given by D divided by PO minus F. Then you show it as a percentage. So you write that as the formula. So KB now is the cost of the preference share. So it is simply equal. So D is the dividend per preference share. So that D is simply the dividend per preference share. And we know PO is the market price of the preference share. Is the market price of the preference share. Then F, we know it is what? The flotation cost. So there is no much on that. When we get the question, we shall go back to it and analyze. So finally, we got the cost of the debenture or the bond. The last category was cost of the debenture or the bond. Cost of the debenture or the bond. The next one should be cost of debenture or the bond. So now at this point, we write that the bond or debenture is classified into two categories. The bond or the debenture is classified into two categories as follows. It is classified into two categories as follows. It is classified into two categories as follows. Roman letter 1 will be irredeemable debenture. Roman letter 1 will be irredeemable debenture. Irredeemable debenture. So under irredeemable debenture, we write that these are debentures which remains outstanding. These are debentures which remains outstanding. These are debentures which remains outstanding as long as the company is a going concern. These are debentures which remains outstanding as long as the company is a going concern. As long as the company is a going concern. And it will be expressed as follows. And it will be expressed as follows. So KD will be the cost of the debenture. KD will be the cost of the debenture. So it is equal to interest. Interest, then 1 minus the tax rate. Interest, then 1 minus the tax rate. Then we divide by, so that is the current value of the debenture minus the flotation cost. Then we express it as a percentage. So KD is meant to be the interest. KD is meant to be, KD is meant to be the cost of the debt or the debenture. KD is the cost of the debt or the debenture. Then this one is the current value of the debenture. The current value of the debenture. And unit tax rate, T is the corporate tax rate. And this one is the flotation cost. So KD is the cost of the debenture. This one is the current value of the debenture, the current value for the debenture. Then the rest, so that will be interest per annum. So each of one interest per annum or per period. That should be interest per annum or per period. So that's now the summary on how we shall get the cost of the debenture, which is irredeemable. Let us now have redeemable debenture. We go to Roman letter 2. So it was classified into two: a redeemable debenture and also redeemable debenture. The next one should be redeemable debenture. The next one should be redeemable debenture. Redeemable debenture. So when it comes to redeemable debenture, we write that these are those debentures. These are those debentures with a defined maturity period. Are those debentures with a defined maturity period. Are those debentures with a defined maturity period. Then we continue by noting that their cost is equivalent to internal rate of return of the security. Their cost is equivalent to internal rate of return of the security. Internal rate of return of the security. And it is also known as, the yield to maturity. It is also known as the yield to maturity. It is also known as the yield to maturity. It is also known as the yield to maturity, and it will be expressed as follows. It is also known as the yield to maturity, and it will be expressed as follows. Yield to maturity, and it will be expressed as follows. So to calculate KD is the same as yield to maturity. KD will be the same as the yield to maturity. So it will be given by interest in the brackets of 1 minus the tax rate. Then we add maturity value minus the current value, 1 over n. Then we also divide by maturity value plus the current value. So this one we multiply by and we express it as a percentage. So KD or yield to maturity will be equal to interest in the brackets of 1 minus the tax rate. Then we add. So this one is maturity value. This one is the maturity value. It was the current value. This one was the current value. So N is the maturity period. N will be the maturity period. So this one is interest, then 1 minus the tax rate plus maturity value minus the current value. Then N is the maturity period. So this one is a repetition of that. So that is now how we shall be coming up with the cost of the bond or debenture, which is what? Redeemable. So we go straight to some questions on that. Let us now get some questions in relation to that. So the first question I would like us to deal with, I want you to check December 2012, question 2E, December 2012, question number 2, part E. December 2012, question number 2, part E. December 2012, question number 2, part E. December 2012. Question number 2, part E. December 2012. Question 2, E. Question number 2, part E. December 2012, question 2E. So that question 2E, are you able to see Naziri Investment Limited? Yeah, so Naziri Investment Limited is currently sells bonds at shillings how much? 1,200 with an 11% coupon rate. With an 11% coupon rate. And shillings 1,000 bar value. Shillings 1,000 bar value. The bond agreement provides for the payment of interest on the annual basis. With how many years to maturity? 18 years. So required the bond yield to maturity. They would like you to compute the bond yield to maturity. The bond yield to maturity. So to calculate the bond yield to maturity, what we need to compute first. So we have said that the yield to maturity. So the first item will be interest. The first item will be interest. So interest will be 11% of the bar value. 11% of the bar value. That will be 11% of 1,000. Get 11% of 1,000, which is supposed to be 110. So maturity value today, we say in the morning that maturity value, unless otherwise stated, it is the same as the bar value. Maturity value, unless otherwise stated, it is the same as what? The bar value. If they specify that it was issued at a discount or a premium, you calculate. But if they have kept quiet, the maturity value will be the same as the bar value, which is 1,000. Then, current value of the debenture or the bond. The current value of the debenture or the bond has also been given. It currently sells at how much? 1,200. So N was given as how many years? So T is not given. The tax rate has not been given. So when it is not given, we assume it is a 0. So to compute the yield to maturity, it is simply interest 1 minus the tax rate. We add maturity value minus the current value, 1/18. Then we also divide by n, so it's 10. Then maturity value plus the current value, we multiply by half. So interest we have seen it is 110. So there was no tax. Maturity value is 1,000. Current value is 1,200. 1/18. Also divide by what we have there as 1,000 plus. Then this one we multiply by half. Then we express it as a percentage. Then we express that as a percentage. So compute and see what value we come up with. So you are getting pattern at the online, you are getting which value? You are getting which here? 8.99. Online, you are getting which figure? Yeah, so majority of them are saying 8.99. That should be the correct value. It is meant to be 8.99. It should be 8.99. Yeah. So let us check another question. So go to June. I want you to check the one for June. I want us to check the one for June 2013. Question number 5, part D. Go to the next sitting, June 2013. June 2013, question 5D. Where you are, just go to the next. Because the one we did was December 2012. So now we go to June 2013. Question number 5, part D. So June 2013, now we go to the question number 5, part D. June 2013, question 5, part D. Question number 5, part D. So that question 5D for June 2013. Question number 5, part D. Question number 5, part D. So the question reads that Everex Limited has bonds which currently sells for how much? 11.50 with an 11% coupon interest rate. With an 11% coupon interest rate. And shillings 1,000 per value. Shillings 1,000 per value. The bond pay interest annually. The bond we pay interest annually and have 18 years to maturity. And they have 18 years to maturity. The company's tax rate is what percent? 13%. So required, Roman letter 1, the current yield of the bond. So let us first see how to calculate Roman letter 1, the current yield of the bond. How to get the current yield of the bond. So current yield of the bond. The current yield of the bond. The current yield of bond. When you want to calculate the current yield of the current yield of the bond will be given by the interest per annum. You simply get the interest per annum. We divide by the market value of the bond, the market value of the bond. Then we express it as a percentage. When you want to calculate the current yield of the bond, it will simply be given as the interest per annum. We divide by market value of the bond. Then we express it as a percentage. So first, we calculate the interest. Interest is normally calculated on the par value. That interest rate was 11%. So it is 11% of the par value. 11% of the par value, which is 1,000. They have given us, so it will be how much? The market value of the bond is also given. Market value of or current value of the bond is also given. It is currently selling at how much? So now you can calculate the current yield. You simply take 110 divided by 1150. Show it as a percentage. Show that value as a percentage. Then we show that value as a percentage. So it has given us what percentage? Yeah, so now we go to the Roman letter 2. Roman letter 2, yield to maturity of the bond. The yield to maturity of the bond. The yield to maturity of the bond. The yield to maturity of the bond. So to calculate yield to maturity, it is simply given by interest 1 minus the corporate tax. Maturity value minus the current value 1 over n. We also divide by maturity value plus the current value. So this one divided by half. Then we show it as a percentage. So we said that maturity value, unless otherwise stated, is the same as the bar value. Remember that note. Yeah, unless they have specified, it remains the same as the bar value, which is how much? 1,000. So current value of the bond is what we have given as 1,150. You see that it currently sells at 1,150. Then we calculated, so n is still 18 years. You can see n is 18 years. Then the tax rate has been given as 30%. So the only item interest, we had also already calculated interest. Nakumbuka the 11% of the 1,000. So 11% of the 1,000. It had given us 110. So from there, we can now compute our yield to maturity. So interest will be 110. 1 minus 0.3. Also maturity value will be 1,000. Subtract 1150. So 1 over 18. Also divide by 1,000 plus plus 1150. This one multiplied by half. Then show it as a percentage. Then show that as a percentage. So now it has gone down to 3. Yes, because it was like this one. So there is a tax. It must be able to go down. It's up there. I've seen online 6.3. Online, I've seen something like 6.3. I've also seen 6.39. So you do this way, calculate this separately, uweke mahali, compute your separately, uweke mahali, here you separately, put it somewhere. And now you combine all of them. It will be so easy for that. But if you combine them together, chances of making a slight error is high and give you a different value. So that is now meant to be our Roman letter 2. Where you are required to calculate the yield to maturity of the bond. The yield to maturity of the bond. The yield to maturity of the bond. So after that, we need to go to the Roman letter 3. Explain the relationship between the calculated yield to maturity, current yield, and coupon rate of the bond. Calculate the yield to maturity, current yield, and the coupon rate of the bond. So first, we should make a small summary of the information. Should make a small summary of the information. So the bar value, you can see the bar value was what? The bar value was 1,000, but it is currently selling at what? 11. It's currently selling at 11. Then also from the details, the question we calculated, so coupon rate coupon rate was given as what percent? 11%. See the 11%? Yeah, and then you calculated the current yield. Current yield, we got what percent? 9.6. Then now the yield to maturity is 6.39. Maybe we can just have it as 6.4. We can have it as 6.4. So from this analysis, you can see the coupon rate is greater than the current yield, which is also greater than what? The yield to maturity. And because of that, the bar value is 1,000. But it is currently selling at what? 11.50. So in case the coupon rate is greater than the current yield, which is also greater than the yield to maturity, this bond is selling at a premium. The selling price is higher than the bar value. So we shall be explaining it in that manner. So you will write these ones, then we will summarize it the first dash. We summarize it as the first dash. So the first dash, we shall say that if the coupon rate is greater than the current yield, which is also greater than the yield to maturity. So if the coupon rate is greater than the current yield, which is also greater than the yield to maturity, then the bond will be selling at a premium. Then the bond will be selling at a premium. Then the bond will be selling at a premium. Then the second dash, we also say that if yield to maturity is greater than the current yield, which is also greater than the coupon rate. So I'm just reversing. I've just reversed that if the yield to maturity is greater than the current yield, which is greater than the coupon rate, then the bond will sell at a discount. Then the bond will sell at a discount. Then the bond will sell at a discount. Then the last dash, we say that if the coupon rate is equal to the current yield, which is also equal to the yield to maturity. If the coupon rate is equal to, that means all of them are the same. If the coupon rate is equal to the current yield, which is also equal to the yield to maturity, then the bond will sell at par value. The bond will sell at the par value. The bond will sell at the par value on the face value. The bond will sell at a par value or the face value. So that's now the explanation you are supposed to give in relation to that. So another question, we can also refer to May 2014, question 2, part B. May 2014, question number 2, part B. We can also check May 2014, question number 2, part B. May 2014, question number 2, part B. 2014, question number 2, part B. Question 2, part B. So if you can see that question about Sony Limited issued a new bond. It issued a new bond 5 years ago. It issued a new bond 5 years ago. So the bond was sold at par value of how much? 1,000, and has a coupon rate of 12% and maturity of how many years? 30 years. So coupon payment are made semi-annually. Interest rate has currently gone down to what percent? 10%. So required. Roman letter 1 first, the current price of the bond. The current price of the bond. So Roman letter 1, there is so current price of the bond. They want you to calculate the value of the bond. They want you to calculate the value of the bond. So they want you to calculate the current price of the bond. So for me, the current price of the bond, they are simply asking me to calculate the bar value of the bond. They are simply asking to calculate the bar value of the bond. So value of the bond. So the current price of the bond. So to get the value of the bond, value of the bond is the same as the present value of the interest. Present value of interest per annum. Present value of the maturity value of the bond. Present value of the bond. So we have been told that it is paid semi-annually. Interest is paid semi-annually. So our interest rate, you can see the coupon rate was given as 20%. 12. So you take 12 divided by 2. We take 12 divided by 2. So we give us 20%. 6%. Then N, you also need to know N. So N, it was issued 5 years ago and it matures, it was for 30 years. So if it was issued 5 years ago and it was for 30 years, how many years are remaining? 25. So N will be 25, but you multiply by 2 because it is paid semi-annually. Because it is paid semi-annually. So that will be given as how many years? Then also now our interest. Our interest is going to be 6% of the bar value. 6% of the bar value. So the bar value was given as 1,000. So what is 6% of 1,000? Then I say that maturity value, unless otherwise stated, will be the same as what? Our value. Then cost of capital, the cost of capital. Cost of capital is what you are given, that interest rate has currently gone down to what percent? So 10% is per annum. 10% is per annum. So you get 10% divided by 2. Because it is paid semi-annually. So that should be the same as what percent? 5%. So we start with the present value of the interest. So present value of the interest will be annuity multiplied by present value interest factor for the annuity. So that cost of capital is now 5% for 15 periods. For the 15 periods. So annuity is what you have as 60. So I want you to confirm in the table 5% in period 50. I suspect that one is there in the table. 5% should be there in the second table. So in Australia, which figure? 18 points. That is 18.256. Yeah, so that one will give you the present value for the interest. Then also present value of the maturity value. Present value of the maturity value. So when it comes to the present value of the maturity value, so it will simply be multiplied by the present value interest factor. So this one we use the first table. This one we use the first table. So their first table. So 1,000 you confirm the first table. It should be 0.1. Zero point 0.08. 30. 72. Yeah, so now you're answer. So this is now the current value of the bond as indicated up there. The current value. So that now should be the current value of the bond. Should now be able to give us the current value of the bond. Should be able to give us the current value for the bond. 1180. Yeah, so now we go to Roman letter 2. Roman letter 2 is the current yield to maturity of the bond. The current yield to maturity of the bond. The current yield to maturity of the bond. So the term there is the current yield. None of your sentence. Current yield to maturity of the bond. So we shall simply be calculating the current yield. We shall simply be calculating the current yield. We shall simply compute what is supposed to be the current. Don't calculate the yield to maturity. The question has said the current yield to maturity. The current to maturity. So we shall simply calculate the current yield. So current yield from the previous question is interest per annum. We divide by market value of the bond. But for this question, the market value for the bond will be the same as the current value of the bond. You see the Roman letter 1? Yeah, so we should be using what they have given us as the current value of the bond, because that's the only information we have. So then we express that as a percentage. Then we express that as a percentage. So they are saying interest per annum. So we take the interest per annum, which is so we compute per annum, not the way they have been paying. Per annum, it will be 12% of the bar value, which was 1,000 per annum. That interest should be per annum. When you are calculating the current yield, it should be per annum. So it should give us which figure? 120. So now our current yield, it will be 120. So current value for the bond, you use the Roman letter 1, you calculated. We got which figure? 1180. 1182.56. Then express as percentage. Then express as percentage. So it Itakuja which percentage? We get 10.15. So we get 10.15. Then the next one is now the Roman letter 3. The next one should be the Roman letter 3. So Roman letter 3, they wanted you to calculate the capital gain on the bonds. So capital gain will simply be equal to the current yield. The current yield minus cost of capital. Minus cost of capital. So capital gain will simply be the current yield. You minus the cost of capital. So current yield, meniambia ni 10 point what? So cost of capital we use per annum. Remember the one divided by 2 to get 5%. So use the 10% per annum. The cost of capital, remember the 10% then we divide it by 2. But here we use per annum so that we come up with the value for that. So it will be 0. What? Yeah, so that's now the capital gain. So that was in relation to the question. So the time remaining, I will not be able to do any more question on that. But when we meet, remember to remind me, we do the question for November 2016. November 2016 question number 5. November 2016 question 5. So when we meet, we shall do that question, then we proceed on the next part of the topic. So we can stop there for now.